All right, episode 8. Here we go. All right. 5, 4, 3, 2, 1. Hey guys, welcome to episode 8 of the Will and Cody show. We appreciate you guys listening. Last week we talked about math and behavior. Math versus behavior when it comes to financial decisions. But this time we wanted to answer a couple questions. We had a question about inflation. And William, he's going to kind of take over from here because he's the one with the finance degree. And so I'm gonna be learning with you guys today. So I have a general gist of inflation, but he's got all that knowledge. But I was asked a couple of questions. Okay. First is basically, what is inflation? Right. And then should I be, or this person that was asking, should I be worried about it, and what can I do to either prevent it or to help offset that risk? So I guess we want to just dive in about a little bit about what it is, and then kind of get into kind of, I guess, strategies to offset it or to prevent it, I guess. So
okay, yeah, no, that makes sense. It's a topic that's going around a lot lately. It seems like recently in the past month or so, it's really just gone up, and everybody's worried about inflation and stuff. We're talking about it. So just real briefly, inflation is just, think of it as your dollar is buying less, or think of it as things are costing more dollars. So either way you want to think about it. So something that maybe used to be able to buy for $3 after inflation, it cost you $3.50 or $4 to buy. So you can either think of it either one of those ways, that it takes more dollars to buy something, or your dollar is just worth less. Both those things are accurate. Most of the cause, and this is where things can get political, but most of the cause of inflation is just the government's printing money. So think if you only have a certain amount of money that's worth, the market will price and say, okay, this is how many dollars we have. And it'll kind of gauge out how much stuff is worth. But if you add more dollars in randomly, well, then it's like, well, it's worth less because now there's more out there. Makes sense, right? If you've got only a few things, it'll be worth a lot. But as you add more, it's like, okay, it's not worth as much because now there's a bunch out there. So the market kind of corrects. And so that's why we have, prices that will go up.
Gotcha.
And so usually, they'll try to, peg inflation across the board and say, okay, it went up 2%, 3%, 5%, whatever this year. And so they'll try to estimate it and kind of keep track of that, on an annual basis of, okay, here's maybe how much money was printed. Here's how much we think inflation is going to, go up. And so that would just be the simple way of, explaining it. Just over time, as the government prints money, your dollars now buy less. And, as there's more money out there, the buying power of your money decreases. So it's just going to cost you more to buy things that you would normally go out and get. Does that make sense?
Right. Yeah. Okay. So it's basically like, because, when our grandfathers would say, hey, I remember when gas was 25 cents, or, my dad would say, man, I could go get a moon pie and an RC Cola for, a dime or something. And now I can't get a Mountain Dew for, less than $2.
Yeah. Exactly.
So, yeah. Exactly. And that makes sense. And I think the reason that this is a hot topic right now is because of the stimulus packages, the recent stimulus checks. And so there's this worry that, the government's printing a lot to either offset that deficit or to give out stimulus checks and the stimulus packages. I think that's why it's such a hot topic. And I mean, it is a real threat. It's definitely a risk to your finances. When we were doing our internship at the financial planning thing in Phoenix, the number that we used in general, the average number was 3% for inflation. It was just, it changes every year. I think it was like 1.8 last year or something. And it could be like 5 or something crazy in like it was in the 80s. So when we were doing calculations and just talking in general, we said 3%, but it changes a lot. And if I'm not mistaken, it varies depending on the industry and depending on the product. Inflation doesn't really affect this everything the same way. So it's not just across the board a certain percentage. It's kind of just an average. So like your cost of one good could be the exact same, and then the cost of something else could jump up dramatically. And I mean, we see that throughout, the last couple of years in our lifetime.
Yeah.
Gas goes up some, and that's not, gas has more to do with oil and such like that. But we do see stuff like that, and but like you were telling me, you can still get a Arizona iced tea for 99 cents, and it's been like that for a couple of years. So
it hasn't affected McDonald's, you can still get the $1 large. Some places it'll stay the same, and so I think that's something you have to consider with inflation. Is some people can get worried about, they'll see the inflation statistic, it went up 4% this year, but also think that's a generic across the board estimate. So it may not affect you exactly the same. So every person may be affected differently depending on, maybe how much house you own, what kind of car you drive, how often you eat out or spend, or what kind of areas you spend in. All those different things will be affected by inflation differently. So don't take it as like an absolute number of, oh no, I'm going to spend exactly, 3 or 4% more this year because of inflation. It may affect you differently. So kind of be prepared for that. So don't worry as much if you see the number of like, that's exactly what's going to happen to me. It could just, it may not exactly be that number. So it really depends on the industry, as you mentioned, and a lot of different factors. So don't just take that number as a definite. It could definitely, probably affect you.
I see it as like, it does affect us. It affects everybody, but really what it's affecting is the long term. Your buying power of your money right now is not going to be the same buying power in the future. And the longer you go, the less buying power you'll have. And so, if you save $10,000 and you throw it in the bank, then the buying power that 10 years from now may be more like 8 or 7, right? And so, and where it really hits you is super long term, like retirement. And, if you use 3%, if you use the rule of 72, and I don't have that off the top of my head, 72 divided by 3, but whatever that is the amount of years it takes to double your money or cut your money in half, depending on if you're looking at a negative interest rate or a positive interest rate. So, I think it's like 20 something years. So in 25 years, whatever it is, whatever you have in the bank is going to be worth half the buying power. Now, maybe not for everything. You may be, like you said, buy a burger and it's very similar, right? But the general buying power of that sum of money is a lot less. It cut in half, in a little over 20 years. So when we're looking at retirement, especially for you and I, that's 40 and 50 years. So what is that going to look like? And so that's where we need to think about, how to offset that risk. What do we do? And then the answer is investing. And I don't feel like there's a huge immediate threat of inflation. And you can correct me if I'm wrong here, but I think a lot of people are afraid that it's just going to be so immediate. But it's actually something that to my knowledge, takes a while to happen and to affect you.
Yeah, well, it can depend. At least the policy in the past, except for in like the 80s, we always talked about anytime something crazy happened in the world of finance, usually we'll just be like, the 80s, it's back when the crazy stuff happened. So usually they'll try to monitor. And when I say usually the Fed will try to monitor the rate of inflation as to not like shock the system. So that's usually been the policy, is they'll like slowly, monitor that so it doesn't get out of hand, and that, kind of keep a steady pace on it. So that will depend. So I would say usually would be correct. It does take time, if they keep monitoring that. So I think the concern was, if it was going to be too much, that they were printing too much. And so I think that'll depend on what they end up doing. How much, if they're, all the different things that they were tabled, the stimulus packages and all the different things, where's that money coming from, and are they printing it all? I think that will really depend on the effect that we see. So it could be long-term. But if they kind of do too much, then you may see it more immediately. But I would say it's a good point looking at it as a risk, because it is absolutely a risk for long term. So, as we see, as we look at different risks like, volatility and stuff like that, that's another that you want to look at, as, there is long-term risk in inflation. And so as we look at an individual level, how do you take that risk into account? I think you hit it on the head as far as like investing. Because that would be the kind of the cure, if you will, or the opposite, or the mediation of that risk is, okay, if inflation is 3 to 5%, but if you were on an average over, 20, 30, 40 years, able to get around 8%, let's say, then now instead of you losing that money to inflation, now you're making, sure, not as much because inflation's hurting you, but you're making more than inflation. So you're staying ahead of that curve. And that's the big thing is, you want to be growing. Your money needs to be growing faster than the rate of inflation. Otherwise, you're losing money. So that would be the key thing. So the things I'd be worried about, and I am worried about myself with inflation, is any money that's, if you're a big fan of the stick it under the mattress, or just put everything in just a savings account and don't invest it, or, if you're doing any long-term savings, like for retirement, and you're just sitting it again under a mattress or in a savings account, those are things that are going to lose value because it's not making you any money. And so as inflation keeps going, that money is just going to be worth less and less. And it's just a reality of how it works. So I would say if you're doing any long-term planning, you need to take inflation into account and invest it. Because as I like, to think about it, if you're investing in a good asset, so if you're a big fan of, real estate or stocks or whatever you want to invest in, think of it as like a stock is worth, you're buying something, you're buying a stake in a company, right? And so, yes, inflation is a risk, but let's say I buy some stock, right? It's at this price. And so I buy the stock. So now I own this. So instead of my dollars, I bought the stock. And let's say the dollar is worth less and less. But in theory, again, that stocks can move. So this is just a base scenario. But let's say the stock stayed the same. And so the dollar was worth less and less due to inflation. But now I have the asset. So now when I go to sell it, if what I originally paid is down here, I can now sell it for more dollars. Yes, those dollars are worth less, but hopefully the stock has also gone up in price. Whereas if I just would have owned cash, and just, put all my money there over a long period of time, as inflation goes, my money is just worth less and less and less. So that's the main thing, is you want to buy, the investment part is really where it comes in key. For one, just holding the value of your money. So instead of decreasing it due to inflation. And then the second is if you can, investing in things that grow or pay you more than the rate of inflation. So that way you're at least maintaining, plus you're making more than, inflation is decreasing the value. So that's what I'd say. As far as if you're worried about that, just making sure anything that you're holding for the long term is invested. So I consider long term, people think of it differently. I would say probably like 5+ years is what I consider. Kind of that 5 to 10 year range is a little bit like intermediate, but I'd say anything past that is long term. So if you're looking for something like retirement or anything past that window, I would just suggest taking into account this inflation risk of, you're going to want to invest that money.
Right. So, yeah. And I think, like, for me, I think about, well, one, I've got my emergency fund. A lot of people think that, that's at risk right now, but an emergency fund is really insurance. It's not really an investment. So we don't think of it that way. But if you've got,
and that can be difficult. I will say that can be difficult to think of it like that, because if the money's sitting there, right, you're like, oh no, it's going to be worth less and less. And so that's one thing that's going to be difficult. So that's why I set that money aside and I forget about it. So I just want to make that note. Like, as you said, that's difficult just to say like, oh yeah, that money's going to be worth less. But as you mentioned, that's there for just in case. So
yeah, that's an insurance. Yeah. And I'd be lying if I said I didn't put my emergency fund in an investment calculator
right.
8% interest just to see what it turned into.
To see what it would do.
Yeah. So I don't recommend doing that. You need to keep your emergency fund. That needs to be liquid. You need to be able to get that. Yeah. But if you have a sum of money that's kind of like that, investing is, if you think about it, I was trying to explain to somebody this way. When you're investing, it's not like you're putting money into a savings account. Let's say like a mutual fund into your retirement account, like what we recommend. You're buying stuff, you're buying securities, you're buying, depending on the mutual fund or the ETF you get, you could have, it could have some cash in it, it could have some gold in it, it could have some REITs, which is real estate. It could have stocks, bonds, so many different things, diversified, right? And these are things, these are securities, these aren't dollars. So when you look at the value of your investments, that doesn't really equal the amount of dollars. It just equals what it's worth in dollars, right?
Mm-hmm. Right.
And that was something I had to explain. It's like it's not like having a savings account. A savings account is literally just money.
Yeah, it's just money sitting there. Yeah,
that's it. Yeah, and that little tiny interest rate that you're getting from the bank is not anywhere close to what inflation is. Yeah, it hasn't been that way for years. And it did in the 80s, but like we said, 80s stay in the 80s, right? So they had crazy hair back then. That's the reason. I'm just kidding. Yeah, anyway, man, I lost my train of thought on that one. Savings accounts, yeah. So savings accounts, they have a very tiny amount, and that's not doing anything. So a savings account has a purpose. A money market account, very similar, has a little bit more interest rate, but it's not anywhere close to inflation. It has its purpose. My purpose is short-term savings, short-term goals, sinking funds, emergency funds, things that are going to be coming up. There's nothing wrong with having some cash. You need cash. But anything like Will said, anything over like maybe 5 years, it might be best to consider investing in some way or form, right?
Mm-hmm.
And we've already talked about diversification, dollar cost averaging, things like that. So we really won't get into that. But that is really the only way, to my knowledge, to do that. I don't recommend like following the commercials that you may hear on the radio, like inflation's crazy, you need to put everything in gold or silver. I don't really recommend doing that because, again, we talked about diversification, stuff like that. So don't let those kinds of things scare you. Yes, inflation is a real thing. It is a risk. And if you have money just sitting there in a box or under your mattress or in a savings account, it is at risk. So know what your goal with that money is. Know the purpose of that money. If it's just sitting there and you know what's going to be sitting there, maybe consider doing something with it.
Yeah. No, that's a great point. Yeah. It's a good way to round it out there. If don't just let it sit there if you've got a purpose for it. So if it's short term, I am completely fine with letting it, sit there because you're going to be using it soon.
Yeah.
But if it's anything past that, you need to, look at investing that. Otherwise, it's just going to lose its value.
Yeah.
And so, that's something we, maybe don't think about. And it's tough to notice. Sometimes we notice inflation like pretty quick. Other times, it's very gradual. So I would say don't let it scare you, but also don't let it sneak up on you. They kind of be the same. So
yeah,
plan for it so it's not a big thing. And then this is just a side note that some people will say that it's impossible to get ahead because of inflation. I've seen lots of people that will say that or tell me that inflation is 3%. There's no way to get ahead. And so I'll just say that's why I said you've got to invest in things that have a higher return than inflation, because then you are getting ahead. Like that's exactly what it is. Sure, it may not be as fast due to inflation, but it is possible. And so the math shows that of like, there's, average return on a good, index fund or mutual fund will get you enough, to beat inflation and to still make money. So I don't buy into that either. I mean, unless inflation is just astronomical, but at the rates that we've seen, it is possible, to still get ahead in your investments. And so
even in the crazy times, like through history, it's proven investing is the best way to offset that kind of risk.
Yeah. And even too, like people will say, well, in 20, 30 years, everyone will be a millionaire because, or most people will be a millionaire because the dollar just won't be worth much. But I always say, okay, sure, it won't be as much to be a millionaire, but you're still going to need money. You're still going to want to invest it. So even if it changes the figure from, I used to need, $1 million, but now maybe I need $5 million. Well, you still got to go get that number. That doesn't change the fact of it just because maybe the dollar's worth less. You still have needs you need to take care of. You still have planning you need to do. And I think you still can get ahead.
Absolutely.
So I just want to add that note for anybody that's feeling sad about that. Of like, you can't do it. It's impossible. It's like, it is possible. Okay. You can get ahead. It's proven.
Never let someone tell you can't do something in the finance world.
Yeah. Well, unless it's really a bad idea. But yeah,
that's fair.
Anything that's been proven, you could do. Yeah. So that's good.
Awesome. All right. So the second question, or I think we covered that one. It was inflation, and then how to offset that. So the next question was going beyond the 15%. We talked about the 15%, which is for retirement accounts, for your retirement. And as someone asked, and we had actually had a question similar back when we were live, when we were together in person. I was asking, hey, what about stuff that's beyond that 15%? And his question was, at that time, can I take down that 15% to go into other investments? But this question is, what about that beyond 15%? What if I have a little bit more in my margin and I don't want to just throw it into cash? What should I do with that?
Yeah. I think we did cover this a little bit before, but I'd say keep the 15%. And I think we talked about that in the last episode that, hey, it may not be exactly 15%, but I think 50% is a good rule for retirement. So that's money that's set aside for retirement. But anything more than that, and I'm even planning that for my own life on what I want to do, because I'm, slowly getting to where I have a little bit above that 15% that I am able to invest. And so looking at that, there's a few different, options. One, I'd say, is there any goals that you want to go after? So, maybe you want to save up for a down payment on a house, or you have a sinking fund that you need to start funding. So maybe your car is getting kind of old, or you need some repairs around the house that you're going to need to take care of. I would say looking at those things in your budget. But past that, if you're like, okay, we're good, this is purely to invest, I'd say, jump in, to investing. It doesn't have to be, in a in a retirement account. You can just go into what's called like a taxable brokerage account, open one up, and there's these great things called index funds and mutual funds that you can invest in. You may have heard us talk about those before. And so, you can still invest in those same things in a taxable account. And so what I would, say is, for most people, if you're planning on working, in a steady job and planning on working till what we would consider retirement age, which is about 59 and a half, then maybe increasing, that. But for someone like myself, where it'd be like, man, that'd be a great goal if I could retire. And when I say retire, I just mean I can do whatever I want. I can still work. My goal is like, I want to get to the place where I can work, but I don't care about how much I make. Like, I can do whatever I want. I could, just work on my hobbies all day. I could, go do anything else. I could still work, but maybe it's at a small company and they, I don't have to charge them a lot, or maybe it's my own company. You know what I mean? Like I could do whatever I want with my time. I don't have to worry about money. It's truly just, what do I want to do? Okay, I can go do that. It's not based on how much I make or how much I need to make. And so I would love to get to that place before 59 and a half. That'd be awesome.
Right.
So for funds that I want to be able to access before then, and I don't want to take a penalty on the retirement accounts to take that money out, then saving in just a traditional taxable brokerage account could be a really good way to go. I will emphasize, you want to make sure you get that 15% first, because retirement's kind of going to be a big chunk that you're going to want to save for. So anything above that, and if you're like, I would like to retire, I meant to retire early, you don't have to actually retire, then you can start plug in some of that money into just a taxable brokerage account. And then as that grows, you are going to have to pay taxes on it, but you're going to be able to access that money sooner than you would in a Roth or a 401k or an IRA or 401k. And so that could be a really good option if it's long term. And the investment advice is the same. If it's in a retirement account or if you're long term investing in a taxable account. Like I still think mutual funds, index funds are the way to go. Mm-hmm. So I think there's a lot of good low cost index funds out there that you can or mutual funds out there, that you can put that same money into, and it can be, growing as well. So I didn't mean to ramble, but Cody, do you have any thoughts on that? Did I kind of, do you agree? You can disagree. It's okay.
Oh, I agree. Yeah, definitely. I was thinking like, depending on where you are in life, if you are, around, say after 40 and you don't really have that much in your retirement account, it might be best to just pour more money into the retirement account.
For sure.
And in fact, we recommend that if you don't see the numbers going in your favor, if you're looking at the calculator, then the answer to that is pour more money into it. But there is, you can only put so much amount of money into these retirement accounts. There is limits to them.
Yep.
So if you hit that limit and you've still got some margin, then like William said, go for it. Open up a taxable account. If you're younger like us, then the idea of retiring early is awesome, right? And that, having something around 50 years old to pull out of, to maybe not completely fully retire, but maybe just work part-time and then have some money to play with and get ready for retirement. Yeah. That would be awesome as well. And in a taxable account, that's a perfect way to do that. You can invest in the exact same mutual fund that your retirement account's in.
Yeah.
And let's say you want to be, let's say you're young and you're like, you know what, I want to be a little bit more risky about it. There's some mutual funds, index funds that, well, not really index funds, more mutual funds that have more, I guess, risk involved, but more reward. I don't really know what they're called. It's not,
trying to think
just higher risk.
Yeah, there's higher risk things,
Yeah.
There's all sorts of wide range of things. There's, more small cap companies or, emerging markets or stuff like that can be a little more risk, but possibly a little more return, with that.
Yeah. So you could definitely go with something like that. If you want to say, hey, you know what, I want to kind of try it. It's not my retirement money. I just want to kind of try and see if I can make a little bit more. And that's totally cool. I've even thought about doing that myself. I've thought about individual stocks and stuff like that. I don't really recommend that. I've played around a little bit with it, but it's not, at that point, I don't feel like it's investing. It's more like gambling and it's
trading. Yeah, you're just trading at that point.
You're just trading at that point. It's really not investing. So I would not recommend that. If you want to play around with that, that's cool. And then of course, I've been told to throw it all in Bitcoin, but
right.
It's about the same thing. It's about the same thing. So I mean, there's a lot of places to open up these kinds of taxable accounts. The same place that, unless you get a 401k, you can go to Fidelity or Vanguard or, there's even an app called Acorns that you could look at to do something like that. So there's a lot of different options out there.
But I want to emphasize again, we talk about retirement a lot, just because it's such a big need and, it'll be so great, but I don't want you to think that it's all like, oh, we got to wait till, I'm super old to be able to do anything. So it's like, get your 15% so you're set. And if you want to do any more, more power to you. And then, once you've got that met, then you can, as you keep increasing your margin, then you have options of, okay, if we want to invest for an early retirement, sure, let's start doing that. If you want to invest for, whatever, a down payment on a house, if you want to start saving up for that, or I mentioned, any sinking funds, now you have the flexibility to do so. But make sure you got the big things taken care of in that you're working towards retirement. And then you can, I'm looking at this, as well for my wife and I, it's like, okay, if we did want to retire early, how are we going to do that? And so now that we've got our 15% steady and it's going, then we can start looking at those things. And so I say the strategy for me would be the same. Like it's the investment strategy.
Right.
The same. Yeah. I still have a very long-term perspective on that.
Continue dollar cost averaging and
yeah, exactly.
Yeah, absolutely.
So it'd be the exact same thing. just instead of a retirement account, I'm doing it into a taxable brokerage account.
Gotcha.
And I think it's a good thing that you mentioned as well. If someone's getting close to retirement and you're like, the numbers aren't adding up, I'm going to need a little bit more. Okay, let's look at pouring more into those retirement accounts to kind of catch you back up. But as you mentioned, there are limits. So, so feel free to look at, what your Roth IRA limit is, and then looking at traditional IRA or what, you can do in your 401k, all those kind of things to kind of catch back up. And there's a few options you have there. But if you're younger and you got your 15%, or things are just looking taken care of, there's still ways to be responsible and have a long-term investment mindset. It doesn't have to all be meme stocks and day trading and all that kind of stuff. There's other ways other than retirement accounts that you can pour the rest of that above your 15% into. So
yeah, I would say that's kind of like I would put that on the budget as like fun money. If you want to do something like that, and we've talked about this, if you wanted to gamble a little bit or something like that, do some stocks. Say if you wanted to build a business, that's awesome too.
That's true. Yeah, I didn't mention that. But yeah,
that is, and that's something we're going to get into is side hustles, building a business, things like that. We've been focusing on personal finance first because you really got to get that foundation down. I've talked to several people that didn't have their personal finances set up correctly, and they tried to start a business, and it was like two things that were extremely stressful, and I just don't recommend that.
Yeah.
And so, starting a business, that's that in a way is an investment as well.
One. Yep. Yeah, I forgot to mention that completely, but yeah, that's a great point of if you've got an idea and you think it'll work, and then so above that 15%, you could start saving up and be able to pursue a business idea. That's a good point.
Absolutely.
Well,
yeah, just keep that time frame in mind, because like if you're say working on a down payment on a house, you need that in cash. If that's something that's going to happen in 5 years, then it's really not worth investing. Just keep it in a money market account or something like that. Really, when we were talking about inflation, where it hurts you is the long term. And so that's why we say keep that long term in mind. But when it comes to these small things like sinking funds or building a business or stuff like that, then kind of you just keep it in that.
Yeah, it just depends on your horizon. So if you're like, oh, I want to build a business in 20 years, okay, then let's look at where we can invest it. But if it's like, oh no, I want to do it in 2 years, 3 years,
absolutely,
you start setting that,
absolutely
more short term.
Yeah, absolutely. Well, yeah, man, this has been great. We've really enjoyed doing podcasts. I like this medium. It's it's just we get to talk.
It's a good way just to talk and catch up. And,
just kind of figure stuff. I learn when I'm doing this. Like I don't have all the answers when we start doing this.
Yeah.
So
it helps us learn, and then I think it just helps us talk through exactly what we're thinking and try to communicate that better than just what's stuck in our head.
Exactly. Yeah. Well, if you guys have any questions, if you want to get involved, get plugged in, just go to www.willandcody.com and just check us out there. You can submit a question there. You can also follow us on social media and also on Spotify. So send us questions. We'd love to answer them. We were glad we got a couple questions today. We're glad we were able to answer those. Send us questions your way, and we'll continue doing this, and we're gonna keep trucking along and helping people the best we can. Yeah. So, alrighty, guys. Well, we really appreciate you guys listening, and we will see you next time.
See ya.